Hello and welcome to another episode of your Money Moment, the podcast where we simplify complex world of personal finance and investing. Today we're diving into something both fascinating and super practical. It's the rule of 72. I know I've discussed this in the past, but don't worry, this is not a maths lecture. This is about helping you see just how much your money can grow, or in some cases, how much it is not growing. And here's the kicker. We're using the rule to expose how low interest investments are often no match for inflation in South Africa. So grab your calculator or just sit back and let me do the numbers. And let's jump in. The rule of 72. What is it? Alright, first things first. What exactly is the rule of 72? It's a simple mental shortcut to figure out how long it'll take for your investments to double in value based on the annual interest rate or growth rate. Here's how it works. You take the number 72 and divide it by the annual rate of return on your investment. That gives you the number of years it'll take for your money to double. For example, if you're earning 8% interest per year, divide 72 by 8 and you get 9 years. That means your investment will double in 9 years, assuming everything stays the same. Pretty cool, right? But years where things get a little less fun. Low interest investment. Think fixed deposits or saving accounts with rates around 4 or 5%. Take a long time to grow. So let's break it down. So let's take a look at a common scenario here in South Africa. Imagine you're putting away your money into a savings account earning 4% interest per year. Using the rule of 72, we divide 72 by 4. That means it'll take 18 years. Yes, you heard that right. 18 years for your money to double. Now, let's add inflation into the mix. In South Africa, inflation has averaged around 5 to 6% per year in recent years. So while your investment is creeping up by 4%, the cost of goods and services is rising by, let's say, 6%. In real terms, your money is actually losing value. By the time you reach those 18 years and your savings finally double, you'll realize that your buying power hasn't doubled, it actually shrunk. So while your money sits there looking pretty in your savings account, inflation is likely the sneaky thief, quietly eroding its value year after year. So let's look at an example, taking coffee inflation. So in real world terms, say a cappuccino costs 30 Rand today. If inflation is 6% per year, that same cappuccino will cost around 96 Rand in 18 years. Yes, 96 Rand for 1 cup of coffee. Now, if your money is doubling in 18 years at a 4% return, it feels like a victory when your 30 Rand becomes 60. But wait, remember that coffee is now 96. You're actually still short by 36 Rand, which means you're losing buying power over time. And if you're a coffee lover, that is a tragedy. So what can you do instead? Okay, so now we've exposed the problem. So what is the solution? The answer lies in seeking investments that grow faster than inflation. Here are a few options. I'm not saying you have to go and grab all your money and put it in there. You have to consult with a professional like a financial advisor or investment specialist to make sure you're doing the right thing for your unique situation. This is just a broad overview of what options are available. So the first option is investing in equities or shares. The Joburg Stock Exchange has historically offered average returns of up to 10 to 12% per year over the long term. Using the rule of 72, that means your money could double in 6 to 7 years, way faster than those 18 years in a savings account. Balanced portfolios is the next one. If you're not comfortable with going all into stocks, balanced portfolios with a mix of shares, bonds, and other assets can offer returns of between 8 to 12%, doubling your money in about 7 to 9 years, depending on the growth and the fund you've chosen. Number 3 is property investments. While property requires more capital upfront, it's another way to potentially outpace inflation if done strategically. But you definitely need to do your research on property investments, and it might be a good idea to partner with a bigger company and maybe go into a type of REIT investment trust. And then number 4, one I talk about quite a lot, is the tax-free investments. If you're saving in a tax-free savings account, make sure you're choosing funds and instruments with inflation-beating returns, like unit trust or ETFs that are focused on growth. So the bottom line, look for investments where your growth rate is at least 2 to 3% higher than inflation. So you're growing your wealth in real terms, not just on paper. So what is the big takeaway here? Keeping your money in low interest accounts feels safe, but in the long run, it's not doing any favors against inflation. The rule of 72 is your friend. It helps you visualize how hard or how little your money is working for you. Think of it like this. If your money is growing fast enough to buy you that cappuccino in 18 years, it's time to rethink your strategy. And while we all love the security of a savings account, the real security comes from investing wisely and beating inflation. Alright, so that's it for today's episode. I hope the rule of 72 gave you a fresh perspective on how your money grows or doesn't grow in low interest environments. If you enjoyed this episode, please share with your friends and family, especially those still holding on to low interest accounts. And don't forget to follow us on social media and for more financial tips and tricks to help you crush your money goals. Until next time, stay savvy and let your money do the hard work for you.
When you're navigating through life's big events, like buying a home, starting a family, or approaching retirement, you need sound and impartial financial advice. Mauritz Oberholzer, a financial advisor at Stonehouse Capital, specializes in personal financial planning. Visit mauritzoberholzer.co.za or call 082-774-1996. For practical and easy-to-understand advice and tips, don't miss your Money Moment with Mauritz Oberholzer, Thursday mornings at 10 on E-Radio.